So happy New Year to everyone. It's some of you I've spoken to and others we haven't, but I hope you all have had a wonderful break in New Year, and wherever you are around the country, whether you're in lockdown in Perth or covered up in masks in Victoria or having a normal life somewhere else. So thank you again for coming and joining us in our webinar series. We're very excited about continuing this into 2021. And today we're going to run through a couple of different concepts for you. So we're going to do it in our usual Phil and my fireside chat process. So for those who haven't met Phil before, Phil is our National Compliance Manager here at Jonge. Phil, and we're going to play the game. He's going to play Mr. Interviewer.
Yep.
And then probably...
Oh, yeah, I know, but I don't like, especially someone like Terry, I don't like leaving large amounts of WIP there either.
So Bernie's now turned himself off. So
he makes a good point, though.
He does make a good point, yes. So, all right. So, Phil, I'll hand over to you to get started, and we'll let's have a bit of a chat.
All right, Ash, here we are again, mate. A new year and lots of changes and lots going on.
That's it.
Of course, the big thing we want to talk about today is new legislation.
Hang on, let's see if I can get...
Yeah, Bernie, you keep unmuting yourself, mate. So if you could do me a favour and just keep the mute on, that'd be great. All right.
Okay. So lots going on. The big thing to talk about today is the Corporation Amendment Corporate Insolvency Reform Act of 2020. Now, we've spoken about this before in one of our earlier chats, but now that legislation's passed and it came into effect on the 1st of January 2021. So we thought it'd be a good idea to go over it again. But before we get into that, Ash, what else is new in the insolvency space?
A couple of things have sort of changed or gone back to normal, I guess, after the COVID rules. So we had, most of you'd remember that we had the creditor stat demands and bankruptcy notices were extended to a 6-month response period and an increase in their dollar amounts. They've now been reduced back down to the 21 days, which was the original Corporations Act timeframe for responding to them. For the company side, it's gone back to the $2,000 that it always was. For bankruptcy, however, they have increased the threshold for bankruptcy up to $10,000. So it was at 5, and at Christmas time they increased that to 10 to try and make it a little bit easier for people that might have been expecting a little bit of trouble. I think the other interesting thing that happened this year was that, last year, I guess, the ATO's debt book grew from about 46 million up to now 53 billion. So there was an increase of about 7 billion there, just in people who hadn't paid their tax during this period. So that's another thing that we think is very interesting, and probably the ATO are probably going to start wanting to chase it soon.
Right, so only 21 days now to respond to some critical documents in the debt recovery process, being creditors' statutory demand and bankruptcy notices. The ATO is probably going to come out of hibernation, maybe pretty shortly. So it sounds like it's game on again, Ash.
Yeah, for some people it's not going to be a game, but yeah, absolutely, it's back on.
So let's talk about the new legislation that came into effect on the 1st of January. Mm-hmm. Why did the government feel it necessary to introduce these new laws?
Yeah, so this was primarily and sort of fairly heavily promoted by Kate Carnell, who's the Small Business Minister, and there was a real drive that the current insolvency system that we had was a one-size-fit-all. So whether you're a fish and chip shop or whether you were Virgin Australia, you only had one insolvency system to work out to handle and to look at restructure options, to look at protection options. All that fell within one framework. So the idea was to bring in these reforms, why they're called small business reforms, was that they were brought in to try and give some better support to struggling small businesses. There's a belief that there are a lot of companies facing pressure on the back of COVID. Depending on which article you read, sometimes they're saying that there's no pressure and everything's wonderful, and others are saying that there is. So hard to know exactly what it is, but the people listening in probably have a better idea than most. So there is that pressure. The government believes on their stats that about 87% of liquidations in the previous year, so 2019, had debts of under $1 million. So that's what they've structured it under that. And because we've had a large number of insolvencies not occur, so last year there was a 46% drop in 46% drop in insolvencies across the country. They believe that there's a lot sitting around waiting to happen, and having a smaller, simplified system was the concept.
Okay, so that makes sense to me, Ashley. So tell us a little bit about these new reforms.
Yeah, so just before I get into that, the one thing I want to be really clear of from the start with everyone is that these reforms are quite exciting, and I'm really grateful that some effort has gone into putting these into play. But we need to remember, Phil, that they're only a toolkit. They're only an extra tool. They're not the be all and end all, and that at all times you need to be looking at this as it relates to the director and what the director's goals and wishes are. But when we look at where these would come into play, one of the primary eligibility requirements is that they must have debts, total liabilities of under $1 million. So that includes bank debt, credit, unsecured debt, and employee entitlements. Now, there's some variations of that we'll get into. So you must have debts of under $1 million. All of your ATO reporting must be up to date. So all taxes and BASs and all that sort of stuff has to be up to date to be eligible. And the director of the company can't have been involved in something similar in the last 7 years. So there's some pretty strict rules. And then just to wrap it up, the big thing is that the director needs to sign a declaration that they're eligible for this, which is not something that they've had to do.
Okay, so they've got to have done all their tax reporting now, not necessarily paid it, but just reported it. Is that right?
That's correct, yeah.
Okay, great. So look, I can see that would rule out a number of companies, like those that have over $1 million in debt in total, or those that they haven't got their tax lodgements up to date for whatever reason.
Yep.
So as you say, it's not going to be a cure-all, but it could help some people. Let's start by talking about debt restructuring. What does that look like, Ashley?
So we've nicknamed it internally the ALDI docker. So for those who are familiar with the voluntary administration process, at a really high level, it's very similar to the VA process, a smaller version of the same thing. One of the big difference, and Josh Frydenberg, when he first announced all these changes, he likened it to Chapter 11 in America. Now that's what they call a debtor in possession model, which is a bit of an odd name because it's not actually the debtor, it's the director who's in possession. The director remains in control of the company. In a voluntary administration process, the director loses all of his control, and the administrator takes over. So the director remains in control of the business during the period of the restructure. And he continues to trade the business in the normal course. Now, he's got certain restrictions on him once he's under that control, but he can run the business in normal course. He just can't go and sell assets that aren't in the normal course.
Mm-hmm. So that's a bit different to the current voluntary administration process, Ash. And
yep.
I think under that system, if the company continued to incur debts, who was liable for that?
So in the debtor in possession or the director in possession model, the director remains in control, and therefore a creditor acting or wanting to provide credit to the director is providing credit to a director that's actually declared himself a form of insolvent trading or insolvency. So when you're in VA, however, the administrator takes that liability for any new activity from the day that they're appointed. So you lose that protection of the administrator's guarantee during this period. And we see that as a real issue in this model.
So I can see that the director may prefer to stay in control of the business and buy and sell assets in the normal course, but not so good for the creditor because he loses that protection of having the voluntary administrator liable for those debts.
That's correct. Yeah.
Pretty interesting.
Yeah.
And this allows the company to put forward an offer to its creditors in full and final satisfaction of their debt.
Yep.
And so it gives them a chance to restructure the debt and trade on. Is that right?
That's correct, mate. Yeah.
So how does the process work, Ash?
So it all starts with the director making an appointment to the small business restructure, appointing a small business restructure practitioner, which is actually a new role that's been created as part of this new legislation. So currently, any liquidator can also be a small business restructure practitioner, but they've also allowed the ability for a CA or CPA with relevant insolvency experience to request to have a license to be an insolvency practitioner. To be a small business practitioner. But at the moment, I'm only aware of liquidators taking on that role.
Yep.
Once the liquidator is appointed, the creditors, similar to the VA process, they lose their ability to take legal action, and they're in a stayed mode for a period of time while it goes through the process of putting together the offer. As I mentioned before, the director continues to run the company during the first phase of this restructure. And in that first phase, the director needs to come up with an offer to his creditors. Now, that may be that he's going to make payments over 12 months, he's going to make payments over 2 years, or it's a lump sum payment that he's got from somewhere else. Whatever that chooses to be, 100 cents in the dollar, 5 cents in the dollar. The small business practitioner's role there is to assist a little bit in coming up with the offer, but his role is to present that offer, and his opinion is about whether that it is affordable. That's it. It's not, it's not about whether it's in the best interest of all creditors. It's whether the company's likely to do it if there's a better return in another way. It's just purely can the director make the payment that he's offering.
So is it only the director that can appoint a small business restructuring practitioner, or could a creditor try to do that?
No, it's both of the director's the only one who can appoint a small business practitioner.
Okay. So as you said, it's similar to the deed of company arrangement model that we run now, but there are some important differences. Can you run us through what some of those differences are?
Yeah, so one of the first things, what we spoke about before, is there is this liability issue. So when if you appoint a voluntary administrator and you're trading on the business, the administrator takes on the responsibility or liability for the debt. In a business, in the small business restructure, that doesn't occur. The other big one is that who has a right to vote comes into play. So in a small business restructure, related parties lose their right to have a vote. So they don't have an ability to vote in it, whereas in a voluntary administration, they still have their rights to vote. That was brought in to try and avoid people trying to use it inappropriately, but it doesn't take into account for truly legitimate third party or related party debt. So they're two of the bigger ones. The other one is the independence issue. So when a voluntary administrator provides their report, for those who've had the great pleasure of reading them, and there's a few people here who've even had to write them, they're like 140 pages, but the idea is that they assess the offer made under the deed of company arrangement, and they assess that against if the company was put into liquidation. So it's an independent report that's provided to creditors to make a decision on whether it's a smart or a bad idea. You don't have that same report in this small business restructure. So the report is purely, can the director pay the money that he's offering to pay?
Right.
So you lose that independent stuff. But the big one we think that comes into play in the small business market is the related party votes will have a big impact.
Yeah, I think that's really interesting. So they can do a debt restructure if their total debt's under $1 million. But do they have to? If they're under $1 million, could they still do a voluntary administration with a deed of company arrangement instead?
Absolutely. Yeah. So again, as I said at the start, this is a tool, and it needs to be treated as a tool. So if it is the best tool for a business, whether they're under a million or over a million, well, obviously if they're over a million, they don't have the tool. They don't have this small business tool. But if they're under, you still got to look at which one's the best. It's not
What
you don't have to follow this path.
what might make someone that had debts under $1 million still want to do a voluntary administration instead?
Well, one of them is the power of the related party debt.
Yeah.
So that has a big a big play in it. The other thing is that it's keeping creditors on board. So when I look at potentially putting a client in using the small business restructure, there's a fair chance that creditors could turn around and say, well, I only want to supply you money, or I only want to supply you further credit if you pay, or further goods if you pay me up front, because I
Yeah.
don't know if I'm going to get paid on it. Whereas under an administration process, the administrator does take on that liability. So
Mm.
there is a better chance that and if you have to pay cash up front, you're actually going to create a bigger hole for yourself, and it's a much harder cash position when you're already obviously struggling if you're looking at making these options.
So as you say, that's just another option and a lot more to consider when making that decision as just the dollar amount involved.
Mm.
But that sounds pretty good. That's
Yep.
the theory. That's what the legislation says. Do you see any sort of issues in how this debt restructuring process may operate in the real world?
Oh, a very pointed question, Phil.
I
It's a
know.
very planned and pointed question. No,
Yeah.
I think obviously I've mentioned the supply issue, and I think that is truly going to be a big one.
Mm.
The other one is you've got unrelated parties or unrelated creditors who are have full control in the voting process here.
Mm.
So we don't know how they're going to behave in small business restructure or in small business liquidations in the past. The ATO has always been a fairly significant player as a creditor. It's just the way it is.
Yeah.
Now we don't know whether they're going to be supportive of these or not. Now, if they're one of the largest creditors and they vote no, then it's going to be pretty hard to get one of these up.
Mm.
And if the government, even though this is a government incentive, we all know that not all government departments talk to each other. So, and based on past history with VAs and dockers, the ATO have not necessarily been that supportive of compromise systems, and this would be another version of that. So, that to me is a big issue. As we mentioned before, related parties is a concern because you lose the power of some of those votes, those legitimate votes that would otherwise be available. The big thing, however, though, is that, like always, this does not deal with the personal issues. So personal guarantees, the PPSR interests and how that flows through to a director personally, this doesn't cover that.
Mm.
VA doesn't necessarily either, and neither does liquidation, but it needs to be, it's still an issue that's not taken care of. So you could compromise under the vote. Let's say you got everyone to agree to 30 cents in the dollar. Well, if you've got a personal guarantee creditor, they can still chase you for the other 70 cents
Mm.
in the dollar. So you need to consider that when you're looking at it as well.
Doesn't sound quite so good now, Ash, and lots of issues to consider. Let's move on and talk about simplified liquidations. Could you give us a brief rundown on what that might look like?
Yeah, well, again, the same rules apply. There's the $1 million debt threshold. One of the main differences, though, is that employee entitlements need to be paid in full in this one. It's not just an outstanding debt that exists. So the same $1 million, tax returns still need to be completed. The simplified liquidation method is actually a method that's nominated by the director. So you appoint a liquidator and nominate that you wish the liquidator to do this under the simplified system. And then obviously creditors, well, not obviously, this is what we're here to talk about. The creditors will have an option to say no to that nomination.
Right.
It can only be the director who appoints the simplified method. So you can't have a creditor say, I want this guy, can't do a court appointed liquidation and say, I want it done under the simplified method.
Right.
It's only the director making the nomination that allows it.
But creditors can force the liquidator to change from the simplified method to the existing method. How do they do that?
It's done through a voting process. So once the liquidation goes in, the liquidator has to send out a thing saying that it's been directors nominated to do this as a simplified liquidation. If there are any objections, you've got 14 days or 7 days to respond.
Right,
and if 25% or more vote to turn it into a full liquidation, then it reverts back to a full liquidation.
Okay, so only 25% need to say that.
Mm.
So thanks for that, Ashley. That's a good run through on it. So with simplified liquidation, what is different than the existing model?
It's part of the lovely world that we live in where we do things online now. So all the meetings are now virtual.
Yeah, right.
All the reports are done electronically. They've removed the ability to have a committee of inspection, which wasn't used a lot, Phil, but every now and again it did come up that people, and that would actually add a cost to a liquidator because they had to run these committees on the side of running a liquidation.
Mm.
The most of the other stuff that we would see actually is more on the side of the liquidator. So they've got fewer reports that they need to do. So a lot of their statutory requirements have been reduced for these simplified liquidations. The other big one really is there's a change in the voidable and uncommercial transaction rules. So for unrelated creditors, they've reduced some of the rules around preferences. So, and I'll read this to get it right. So the preference payment period is reduced to 3 months from 6, and the minimum amount that they can chase is $30,000.
Okay.
Now, but only for unrelated. So if if you've paid back mum, then they can still chase mum.
Alrighty, so simpler, quicker, easier, cheaper. How much cheaper?
Yeah, that's a good question. So the reality is we don't know yet. So a lot of the liquidators that we have spoken to are still getting their head around it and what they can get away with not doing. So it's one thing to say don't do a report, but they've got certain obligations under the Corporations Act that they still need to check whether things are done. So one of the big problems for most liquidators when I'm talking to them is that they're worried about the converting to a full liquidation. So if they quote $5,000 for a simple liquidation, and then the credit is converted into a full one, what happens then for them? So in theory, there are some benefits and some cheapness, but really, I think same as you, some of the guys have said, "Oh well, not much at this stage."
Yeah,
What I find though is that when you got a company that needs to be liquidated, you need to get a quote. So you go and talk to liquidators about what you want to do, and that's what we do. We work out, go and get quotes for each one.
Alrighty, now right at the start that you said that these were just new options and they were just new tools to have in the toolkit.
Mm.
And I can see why you're saying this now, mate, as it sounds it's not going to work for everyone. And even if you could do it, maybe it's not the right thing to do.
Yep.
And you mentioned earlier that there's lots of options for company directors whose businesses are facing financial distress. Could you tell us a little bit about that? What sort of options might they have?
Yeah, well, and again, this often comes down to what the director's goals are. So, what do they want to achieve? Do they think that they've got a good business that's just been hurt by an event? Are they sick of it? I've had clients come in and just say, I don't want to spend the 3 years fighting back after COVID, so I just want out.
Yeah.
But options range everything from financing or refinancing, setting up some working capital options, through to informal negotiations, moving into using the formal insolvency methods of the VAs and the restructures that we talked about, which is effectively a form of formal negotiation.
Yep.
Through to business restructures, pre-packs, using the lovely word that we, the commercial necessity phoenix,
Yes.
doing that the right way. through to controlled exits and sometimes just going into personal bankruptcy and walking away from it. They're all options depending on what we're trying to achieve.
And I really think getting that independent advice and knowing what those options are is just crucial, Ashley. I'd just like to spend a few minutes, and not too long, but just let's talk through a few of these options.
Yep.
Let's start with financing or refinancing. What might that look like in the current environment?
Oh, well, look, I think most people here would know that there's actually, there seems to be more money in the money market now than there has been for quite a long time. But and there's plenty of cash around to lend, but it's the getting access to it means that you've got to be a pretty good customer these days. So you've got, banks have always loved and finance companies have always loved security. So
Yep.
I think if you're a good business with good security, then that works really. Then there are options there to deal with some short-term issues. The other thing is working capital. Not a lot of people have needed to look at it in the past, but um, one thing that I read recently is that with the drop in sales that's happened due to COVID, the people's debtor books have reduced quite heavily. So then when sales come up quickly, you're actually going to end up putting a lot of your cash reserves into your debtor book for a while. So having an appropriate debtor finance facility sometimes will give you that short-term kick that you need to rebuild up and to rescale your business up, which we think there'll be a lot of people who need to do that over the next 6 months.
So financing might be an issue, but possibly that's just limited to those stronger businesses and ideally ones with some tangible security to give to their bank.
Yep.
Say someone can't get finance, Ashley, throw another option they might have at me.
If they can't get finance.
Can't get finance, yeah.
So, well, then you start moving through obviously the list, and it's not a linear list, but if you've got a client who's got four or five creditors that are causing them a bit of grief, they can't pay them off straight away, but they want to continue to trade, then it might just be an informal negotiation that you get on the phone to them, and with the right type of knowledge of how to present an offer, you can present offers to these clients and say, look, I'm willing to pay you off, but I need 12 months, or I'm going to negotiate a settlement at 50 cents in the dollar or whatever the case may be. So, but you only do it for a select number of people that you need to do it for. It's not something necessarily. So if there's a pressure point, then an informal negotiation might well be the way.
Right.
But if it's a little bit more catastrophic than that, and then you start needing to flow across the whole business, that's when you start looking at the more, the formal negotiations of either the restructures or the VAs or dockers and things like that.
Okay. So I take it the informal negotiations probably cheaper in terms of professional fees, maybe a bit quicker to reach an agreement and get through that process.
Yep.
But as you say, it's only going to work for a small number of creditors. And what I've seen in my experience in the past, that critical issues can be the relationship that the director has with that particular creditor.
Yep.
That when things get personal, that can be a bit of a problem. And that one really hostile creditor can pretty much derail the whole process.
Absolutely.
So assume if you ran into something like that, that might be maybe an opportunity to look at a formal negotiation or a different option.
Yeah, well, and certainly if you tried informal and then you needed to go down another path, sometimes you look at it and you go, no, it's not going to work, so you move straight on. But it's and I want to be clear that these aren't linear, Phil, as you know. But yeah, I mean, if you tried to do the informal approach because you knew you only had a few creditors and one's being a bit of a pain in the butt, then you might need to look at going to a different version, which is either the small business restructure, where you still want to keep the business in its current form. So you'd use the small business restructure or a VA, indeed a company arrangement, which would force all creditors to meet whatever the compromise is, as long as you can get the right votes. And I think that's the beauty of the formal methods, is that a rogue creditor, unless they happen to be the most powerful one for voting, which then you wouldn't use it in the first place, but a rogue creditor can't undo the good work that everyone else is willing to offer. So
I think, as you said earlier, the composition of creditors is important. That if you had a large number or a high value of related party creditors, maybe you're better off going with a deed of company arrangement rather than a debt restructure.
That's correct. Yeah.
Would be a valid point. Okay. All right. So we could try all those different things, but in all of those options, actually, you either need a lender or a creditor to agree to it all. Now, that means putting up a sum of money. And sometimes, companies in financial distress may not be able to raise the sort of offer amount that's going to get creditors to vote in favour of it.
Yep.
If I face something like that, what you mentioned earlier, that you could do a commercial necessity restructure of the business?
Yep. Yeah.
Tell me about that.
So commercial necessity restructure is I mean, we use these terms probably a little bit tongue in cheek when you and I are talking about it, but because the legislation that most people may not even know came out last year in the middle of the pandemic, that actually made these restructures effectively more legal.
Yeah.
Now, you'll know the legislation name. It's not my area. I just know it's there.
I'll give it. It's the Treasury Laws Amendment Combating Illegal Phoenix Act of 2020. And that distinguished between illegal Phoenix activity and legal Phoenixes, which were referred to in the legislation as a commercial necessity restructure. So you're quite right. A lot of people think that they hear the word Phoenix and they think it's illegal. Well, the legislation has actually come out and said it is entirely legal if you do it the right way, if you do it properly and legally.
Yep. Yeah, and I think that it is a very valid and a very good choice for a lot of people to use that to give their business a second lease of life. Yeah, and there is very strict protocols on how you need to do it the right way to ensure that the director and everyone else is protected properly.
So tell us all, how do you do it the right way, Ashley? What does that process look like?
At a really high level, it's focused around proper valuations. So you need to get a goodwill IP valuations, as well as plant and equipment valuations, so that you can actually work out by independent people. So it's not just a guess out of the air what the value of the business is. Once that's done, you can then enter into a sale agreement. And this is always, subject to general security agreements or other security interests that are in play. But you enter into a sale agreement with a new entity to buy that business and take over staff entitlements or not, or whatever is part of the sale process. The new entity then must buy that with cash.
Yeah.
We've seen in the past some fairly interesting ways of purchasing. But in our mind, it has to be real consideration that's paid from new co to old co for that business. Once that happens, you then put the company into liquidation. The liquidator will then review those transactions to ensure that they meet within the legislation and allow the business to move forward from there.
So you've got to get valuations, you've got to pay a fair price, and you actually got to pay the money. And in that way, no creditor's really being disadvantaged. They're getting full value for the assets and goodwill of that business.
That's correct. Yeah.
All right, now that's about people wanting to continue in that business, but I think what we're seeing as people are coming out of COVID is that some of them just don't want to continue anymore.
No.
So what do you do then? It's just turn the lights out, lock the door, and appoint a liquidator?
I think some people would like that, Phil, but but the reality, I think one of the big things about saying that you want to close down your business is that there can be two events. One is the actual shutting the doors, and the other is the liquidation. They don't have to be the same thing. So some people feel as if, I'm going to shut the doors, I need to appoint a liquidator today and let them deal with everything. Well, there is still, in most businesses, there's still some value that, whether it be some assets that need to be sold, whether there might even be a client list that can be sold to someone else or things like that. So wanting to get out is about controlling the exit out of the business. If you do it the right way, there may not need to be a liquidation. And if there is enough debt there on top of it all, then obviously that may still happen. So controlling the exit the right way to maximize the return of the company's assets for the benefit of the creditors is critical, rather than it just being wrapped up by a liquidator who has different focuses than what maybe a director or its appropriate advisors would have.
Yeah. Now, we've been talking about companies here all the way through, Ashley, but as you said at the start, there's lots of issues to consider. Things like personal guarantees and the position of the director and their family and what that looks like. To me, that's why you need independent advice. That's why you need somebody that's going to look at all these issues in the big picture and take into account not only what happens to the business, but what happens to the people behind the business. Because to me, it's not much point solving all the problems of the company if the director loses his house.
That's correct. Yeah. And I think it is one of the things that we spent a lot of time focusing on is making sure that people understand that we don't have a conflict issue, Phil.
Mm.
So an independent advisor can look at it and I don't have to make a decision on whether I help this bit have an impact on that bit. We can be there, and our job is to look at the director as a whole, and it's important to look at the whole. It's not just as you said, you can look at the company, but what's the flow through? What does it happen at the personal level? And sometimes if you want to protect there's something that needs to happen here.
Mm.
And so having that holistic, independent, but also there's no risk of conflict issues in what decisions are made. So, and that's why the right type of business that can do that is critical in these situations. So, and there are a lot of pitfalls. A lot of things can happen at the personal level that flow through.
Mm.
Over the years, you and I have both had plenty of clients who went straight to liquidation, and then they ring us up and go, "Oh, I've got this letter and that letter, and they're going after my house now." And some of those things could have been dealt with better if we'd got in earlier.
Now, as you said earlier, at the moment, only liquidators can act as small business restructuring practitioners. And I think if you go in and you talk to a liquidator, there's a possibility that they may only look at the company side of things and may not take that big picture view about where the liquidator is. Now,
and we're not saying that because we're beating them up.
No.
It's their legal right to. That's their legal obligation to do that. So
I'm not suggesting they're doing anything wrong, but
no.
that's their game, and quite naturally, that's where they're going to put their focus.
Yep.
Now, we haven't really spoken about bankruptcy, but I know you and I could probably sit here for another hour, Ashley, and talk about all the ins and outs of that. But if I could just say briefly, there's a lot of misconceptions about bankruptcy. A lot of people think that if you go bankrupt, you're automatically going to lose the family home and lose the car and lose everything. And that's simply not the case. That if you get the right advice, you can protect personal assets in a totally legal and totally proper way. And sometimes, as we said earlier, we've been talking mainly about the corporate side. Don't forget about those personal guarantees that are out there. They still need to be dealt with effectively as well. So really, Ash, I think we're just about out of time.
Yep.
Did you have any last thoughts you'd like to leave us with about these new changes and how it all works and how it all fits in?
Look, if anyone has any questions, you're more than welcome to either use the chat box or or you can raise your hand, and then we can unmute you if you want to ask a question, or you can just put your question in the chat. But I guess to wrap up, I'm actually quite excited about the new legislation. I think it's good that they finally recognise small businesses not being the same as the multinationals. So having those extra tools available for our clients is a really cool thing. It just gives us more options. It gives us better ways to look after and protect them. So, but they're just that. They're just another tool that we need to be really careful and work out which is the right one at the right time to use. So, and for me, that's the big thing. There's a devil in the detail, as there always is with legislation, and there'll be even more devil in the detail once a few of these are actually run. And then they end up in the courts over the next 6 months when things aren't done quite the same way. But it hasn't been overused at this stage, but I actually think it's probably too early. So I think there's an expected insolvency wave, or a tsunami, as some people have called it. I don't think it's going to quite be the tidal wave that some have tried to make out, but it will come. But it's still a bit early to see what it looks like. But in general, I'm pretty excited that they used COVID to push some of these things through.
Okay, great.
So,
Thanks, Ash.
Thanks. So, guys, if there are any questions, here's my other thing. There's apparently everyone wants to know in the office whether you think Phil and I are cool or crap at this. So there's a little webinar feedback in place. So please fill that in as you can and tell us what you think of it, so that we can try and make sure that we're giving you the best and most relevant information. So we'll be back again next month in some format or another. I think this year is going to be a year where things will happen quite quickly and changes will be made, and we look forward to bringing those to you in the freshest and best way that we possibly can. I can't see any questions coming up at this stage, so Elise,
Can you guys hear me?
There's no questions in the chat.
Yep, I can hear. Is that you, Peter?
It's Peter Hogue here. I just want, it's a great presentation, gents, much appreciated. I just wanted to clarify, when you said about the simplified liquidation, you said that the creditors can, via a voting process, effect a change to a normal liquidation. And I didn't know if I got the percentages right. Was it 25% of the creditors could derail a simplified liquidation, or was it 75%?
That's 25% by dollar amount that they are owed, and they need to make the request in writing.
Thank you, Phil.
No problem.
So
That's not a lot, really. Only 25%, and they can change it.
Yeah, it looks a bit in the light side.
Yeah. Is that it, Peter?
Yes, that was my question. Thanks, Ashley.
Okay, awesome. Nothing else? There's none in the chat box. So if there's no questions in the chat box and no one else wants to unmute themselves, then really appreciate you taking the time in your day to to listen to us. I'd like to say talk, but this is a little bit one-sided. So Phil and I have fun. I hope you've enjoyed it, and I look forward to seeing you all next month where we can. Now, yes, there was one other point I'll make before I just turn everyone off, and that is that what we've talked about today with the simplified liquidation, the restructure, we have normally, as most of you know, we'd run a breakfast seminar series with the lovely world that COVID is. There's obviously some risks in doing that. We have, however, created a seminar with a lot more detail than what we've talked about today, that covers all the same points about the new legislation and the options. We would love to run that for you, either in-house or virtually, if you for in your businesses, so that you can get some updated training for your staff. And that will also give you a lot more detail around what we've spoken about today. So if you would like that information and you'd like to get that training, then please reach out to your strategist or to the strategic partnership managers in each state, or to Phil and I and Hank as well, and we can do what we can to get that set up for you quickly. So we're really excited about the presentation, as we often are with our breakfast. We put a lot of time and effort into it. We just need someone to show it to now. So so please reach out if you'd like that training internally. All right. Apart from that, still no questions. So I'll thank you all for coming along and watching the Phil and Ashley show.
Yeah,
and we,
thanks a lot, everybody.
Yeah, and we look forward to catching up again next month. Thanks, everyone. Goodbye.